Hi, I'm Ross from Kermsmith Property Accountants, and we're just going to look at a situation that I see all the time with business planning. So obviously we're property accountants, and we focus more on the property side of it. But yeah, as part of that, we also link the business and the property and the overall structure. And it's just amazing how often that we see terrible structures and just terrible ideas like this. This is one that's just come across my desk today. We do the property side, someone else does the business side, another accountant, and this is just a terrible example of how to pay an extra 10,000 in tax for absolutely no reason at all. So we've got a structure set up, and this is a sort of standard structure that we might see. They've got a trust. The trust owns the personal house. They've got a separate business operated through a limited liability company. The shares in that are owned by the trust. This is great. That means the profit from the business is going to flow down to the trust. The trust could then allocate it out to children, lower income earning spouse, other beneficiaries, which is great. We'd normally have long-term hold rentals in a separate LTC, also owned by the trust, so the profit and capital gains long-term flow through the trust. If we had another business, a commercial property, something else, generally in a separate entity, also owned by the trust. So the trust becomes the central entity that owns everything, and everything sort of flows into that. If we're investing money into the business, we generally do it from a formal loan. The trust would loan the money, formal loan with something like a general security agreement done through your lawyer up to the business. So if the business goes bust, the trust gets its money back quickly or a higher priority than a lot of the other debts. Probably not ahead of banks, but yeah, ahead a lot of creditors in the IRD. We try not to have any money going from the business to the long-term rentals or the long-term rentals back to the business. So we try and not have those two linked together. So that's sort of a structure, and this business was set up like that. We had the business, we had it owned by the trust. It's all looking good. The business made about $400,000, a bit over $400,000 profit before the owner was paid something. The owner was paid a PAYE wage of $150,000, which was about their fair market value for the work that they were doing. It was reasonable in that point of view. It wasn't just for personal services, so we didn't have attribution rules problems. It's a proper business with staff and other products and services that it's selling. The accountant then paid the extra $250,000 shareholder salary to the shareholder owner. So we've got two really big problems coming up from this. So just to summarize again, 400,000 profit, effectively all paid out to the shareholder owner. So it's all going through to them. So why is this so terrible? Number one, asset protection. We set up the shares to be owned by the trust so that a lot of the profit from the business flows through to the trust. It's then protected from the individual. If they get sued, they have a health and safety nightmare, the trust is completely separate from that. So really important, we want those profits going through to the trust. The trust can then pay off the personal house mortgage or loan it to its rental company to buy some rental properties. It can invest in shares or funds and things like that, and all separate from the owner themselves. So by giving the 250,000 extra to the individual, we're giving the individual wealth rather than the trust wealth. So we're getting no asset protection. If he gets sued, he's going to lose that extra profit. The next thing is extra tax. Though he's already getting 150,000 salary, so he's going to get 30,000 more at 33%. Then the extra 220 is going to be at 39%. If we just left that in a trust, if we left it in the company, initially people get excited and go, it's 28%. It's great. We're only paying that. But sooner or later, he wants to get that profit out and he wants to use it to pay off his personal house. So in a normal structure, the company would pay 28%. It would then do dividends through to the trust. The trust would pay 33%. So 33% is the real long-term tax rate. 28 is only an interim one. And I'm going to have some videos coming up about that more in the next few weeks. But for now, 30% extra, 30% at 33, 220 at 39%. So obviously we're paying 6% extra tax on that 220. That's 13,200 extra tax. So this is just it's a classic example of how often we see it, that accountants just not thinking through. This one, we've actually set up the perfect structure. It's all been done right, and then it's been ruined by the shareholder salary coming through, rather than some planning around tax, the profit being left in the company, paying the 28%, some dividends through to the trust, and yeah, the full 33% paid, but 33% on the 250 is a whole lot better than paying 39% on 220. So 13,200 less tax in 1 year. Yeah, it's a lot, and it's just from a stupid little mistake. It's just from not being smart, not planning ahead, not utilizing structures properly. So be very careful, one, how you set up with a business, and two, how you're actually using this. This higher shareholder salary is just stupid. So yeah, hopefully you enjoy that. Hopefully you got something out of it. Thanks a lot. Bye.